Welcome, my name is Libich, and I'm really pleased to be joined by one of the most prolific Polish economists, Professor Cezary Wojcik. Welcome, Czarek. Thank you for joining us.
Thanks for having me.
Today we'll be talking about the euro, about the common currency in the euro area, and Cezary is a great expert in this area. He was the head of the National Bureau for the introduction of the euro in Poland. He was advisor to the governor of the National Bank of Poland, advisor to ministers of finance, and one of the most cited economists in Poland. So we're really looking forward to your expertise. Let's just start from the basics. Will the euro survive the next few years?
Okay, so before I answer this question, I just want to make something straight. Namely, I don't know what is going to happen in the future, and probably a lot of things that I'm going to say during this interview is wrong. But
so you're not a fortune teller, are you?
I'm not. But having said this, I believe that the euro will survive, and to be more precise, I think that it's not going to break up, no country is going to leave the euro, and within the next couple of years, the euro area will be expanded by additional countries, by new countries.
That's a pretty strong prediction. So what makes you say that? I mean, what makes you believe that the euro has a future?
Yes, so I think, Winston Churchill once said, it was during the wartime, he said, I don't know what Soviet Russia will do. It's like a puzzle wrapped up in a secret and put into an enigma. But he said, but maybe there is a key to it. And the key is the national interest of Soviet Russia. So if you go along these lines, we could think, so what are the interests, economic interests of all these countries within the euro area, but also the euro bloc, as we call it, and also in the geopolitical kind of space. And I think if you look at all these dimensions, I think there's a lot of interest, economic interest, to keep euro together. And so remember, the euro area is not only 17 countries, but it's a euro bloc. It's about 50 so countries, which makes up about 20% of the world GDP. And so even Poland or the Czech Republic are part of the euro bloc countries. And I think from the perspective of the Czech Republic or Poland, is not actually a great scenario for the euro to break up, because our monetary systems are linked to it. So countries like ours are not interested in a breakup of the euro.
I agree with you, but I mean, one thing is the will, and one thing is the intention and the incentives, and the other thing is whether the system can actually work. And I think this kind of leads us to the discussion of the advantages and disadvantages of a monetary union. So can you maybe briefly outline what are the advantages of a monetary union to start with?
Yeah, so the most important is trade, and it always was, because when currencies are fluctuating a lot, it's very difficult to conduct trade. And I think when you have one currency, it facilitates it so much. And given the trade links between countries in Europe became so huge, this is really a benefit. But on the other hand, the cost is that you have one monetary policy that does not always feeds, your national preferences. And the challenge for Europe is, how you align economic structures and institutional structures so this cost, is not too high. And currently what we see, it is pretty high.
I mean, you mentioned that sometimes the common currency is not suitable for all countries. Some people would go even further and they'd say that it actually is suitable for none of the countries. This is what's called the one size fits none. So can you maybe, for the people who are not familiar with the economics argument, why is monetary policy important in the first place, and why giving it up by adopting a common currency, why can it be problematic? What's this one size fits none thing is?
So the monetary policy, if you run it well, allows you to have a stable growth over the long run. Stable growth rate is a key here. And when you transfer your monetary policy to a European Central Bank in that case, you lose a little bit of this possibility to stabilize the economy and have a stable growth rate over the long run, or stabilize it somehow. So this would be the main cost, I think, and some countries like Greece, for example, they are struggling with it. But the problem of Greece are not necessarily related today to the monetary per se, because there are a lot of structural problems in this country that would probably show up irrespectively of the monetary policy they would run.
So if I could use an analogy, monetary policy we can think of as a bus driver and kind of going along a windy road, and if you're going too fast, the central bank's kind of going to step on the brake, which means it's going to raise interest rates and kind of take the speed a little bit to make it safe. On the other hand, if the bus is going too slow, it's going to step on the accelerator by lowering interest rates and going to stimulate the economy. And the idea is to have a stable speed that's neither too much nor too little. Is that a good analogy, or would you?
Yeah, it's a very good analogy. The problem now in the euro area is that you have these passengers. You know, there's this German and there's this Greek and there's this Spain and there's a person from Spain and Portugal, and each of them is wants a different speed. And the driver has to decide when actually to brake and when actually to accelerate.
And obviously you can't, and that's the thing, you can't step on the brake and on the accelerator at the same. You can't accelerate and you can't slow down at the same time.
Yes. So what do you do in such a situation? In economic terms, you look usually at the most important and the most sizable economy, which in that case is the core of the euro area, Germany and France. And these countries they are not. Their kind of equilibrium, growth rate is pretty low, which would suggest to have over a longer period of time a low interest rate. For some countries that are growing fast, it would mean a high interest rate. So we have this difference, and it's not really easy to strike a balance.
Well, some people would say it's not even possible to do that. I mean, if for example, in the current situation, Spain and Ireland and countries on the periphery who are suffering a recession and very high unemployment, they would very much need the bus driver to step on the accelerator.
Yes.
But because that could mean that we're going to experience higher inflation, the countries at the core, like Germany and so on, very much resist this move. Is there a conflict, or how do you reconcile this problem? What can we do? Or are there any other instruments, maybe fiscal policy, that we can bring in the picture to provide for this inefficiency or problem?
Yeah, so there is certainly a conflict. In the current situation, countries like Greece or Spain, as you said, would like to have as much low interest as possible to stimulate the economy, and Germany would actually maybe need a little bit high interest rate. So the conflict is obviously there, and it's not easy to reconcile that. And then you can ask, what could be the other policies that you can employ? And obviously the first candidate is the fiscal policy. But the problem of Greece and Spain is that they came to the limit of how they can use the fiscal policy. Even though there might be a possibility, there might be a reason for them, or it could be reasonable for them to expand a little bit to provide some more domestic demand, the financial markets are not willing to finance it, because eventually you need to finance your fiscal policy somehow. So these countries are to a large extent cut off from the financial markets, and the question is, how do you provide funding to them? But if you want to provide funding for them on the official or the state level, then the question becomes political, because then you have to ask a German electorate, do you want German taxpayers' money to be moved to Greece, or do you want Slovaks' taxpayers' money to be moved to Spain? And it becomes very political, and people of course resist to a large extent.
So in order to kind of release this pressure and maybe reduce this resistance, some people suggest that we should have a fiscal union in Europe, which would somehow maybe kind of formalize the transfers from countries that are currently growing to countries that are not doing so well. What's your view on the fiscal union front?
So I think it's right, but it's too simplistically said. I think because if you look at successful monetary unions, and then you would see that in most of them there's also some sort of a fiscal union. Look at the United States. I think this is an example that is the closest to what we have in Europe. and you have several states that are pretty independent, and there's some federal government, right? And there are local fiscal policies that are run by states. So if there is any route for Europe to go, I think it would be in that direction, to have some federal, maybe not government at this stage, but have federal budget, right? And that you can use to provide funding for stability reasons to different regions or countries, as we call it today. But to achieve this, you need a political agreement to do that. And we don't have this political agreement yet, although it's building up a little bit. Because if you look at the European Stability Mechanism, so the pool of resources, the amount of 500 to 750 billions of Europe, it's a way of consolidating part of fiscal public finances in a center and using it to provide funding to countries in need.
I mean, you mentioned the political constraints, but even even the fact that some of the poorer countries should provide funding to some of the richer countries is kind of resisted by many people, so kind of the goodwill doesn't seem to be there.
That's true, and it's reasonable, but it's part of the process. Mm-hmm. In some ways, the question is, how do we understand borders in Europe? What a border means? And we are in a process of trying to answer this question and re-evaluate this question. Mm-hmm. For example, the whole process of European integration is a process of redefining this, what it means a border between two countries. For example, a Schengen agreement, right? At some point, people decided in Europe that border is not a place where there is a customs duty officer and stop you at the border, and they allow you to go or not. At some point, they decided, no, a border could be a place which is free to go. And this is a Schengen agreement, right? And then now we have to understand what a border means for financial transactions, okay, between Greece and Germany, Spain and Germany and all other countries. But it's a difficult process because in this process some people feel that they can lose something. For example, Slovaks, they cannot accept the idea today that they can finance part of their taxpayers' money that they work hard for, right, to Greece, where pensioners have a much higher pension. And this is reasonable.
So thinking through we mentioned fiscal union, thinking through the logistics, and you also mentioned the history in the United States. I mean, it has not always been a fiscal union, right? If we go back, and it's not always had a common central bank. These are fairly recent developments. So can you maybe mention?
Yes, and it's an important point. Today, for example, when we talk about the monetary union in Europe, we say, look, it cannot work. It was never possible for it to work because you don't have the key element of a monetary union, which is a fiscal union, right? But if you trace back the history of the United States, you would see that the monetary union that was created there was created not only without a fiscal union, but it was created without a common central bank. The central bank was created only 120 years after.
That's right.
And when was it created? That's an interesting question. It was created after a crisis. And in that case, this was a banking crisis. Mm. Now, the fiscal union was created after 140 years later. And the question is, when was it created? It was created after a Great Depression, a crisis. So this case shows that monetary unions, as any social arrangements, can be dynamic, they can change. And today the question for Europe is, to what extent the monetary union in Europe is a dynamic organism that can actually adapt somehow? Are we going to create new institutions that will form a fiscal union? How are we going to go about it? And it will probably be very difficult. But in other cases, they show that it actually happens during the crisis. And we see that today in Europe.
So basically your optimism about the future of the euro stems from Europe's ability to improve the institutions and to basically make it work. I think some people would have a quibble with this. I think they wouldn't be as optimistic, but
yes. So it's not that I'm optimistic, meaning that everything that happens in Europe is right and I think is right. There are a lot of things that I don't like, and I think there are a lot of things that do not work the way it should work. It's obvious. But I'm asking my questions question is there a chance for Europe to go the same route that the United States went? Of course, given the differences in history, culture, and all these things, this could not be the same route. We cannot adopt the same institutions. We could adapt maybe similar institutions. But the question is this: can we go similar road? Can we, from a selection of kind of independent states or independent countries, go into a strong, integrated, arrangement? And I think there is a possibility like that. And then you could ask a question: is this a good solution for Europe? And I think yes.
Well, let's move kind of more towards the specifics. I mentioned the fact that you were the head of the director of the National Bureau for the introduction of the euro. So it included a team of more than 100 people, and there was this very big report. So what was the conclusion? I mean, should countries like Poland or maybe Czech Republic, other countries like that, try to access the euro? And what's the time horizon? What are the conditions that need to be satisfied?
Yes. So you would have to read the 3,000 pages that we wrote, which is a big report.
I'll give it as an assignment to my students. They'll enjoy it, I'm sure.
Yes. So, but I think what the conclusion of this work, and I think the work I've been doing over the years on it, is that the benefits or the net benefits or the net cost, however you frame it, are endogenous, meaning that are not given. They are not given. So it does not mean. So there are two camps of economists, certainly in Poland, but I think in the Czech Republic, but also in other countries. Okay, one camp is saying this: look, these are all these benefits of euro adoption, and you can see them in all these reports in all these countries that have written reports like that. Okay, so and they say when you enter, they will be given to you. I mean, it's fixed. It's done. It's the truth in some ways. Right? And there is another camp of economists saying, no, this is all kind of a lie. This is not true. There are no benefits. Just look at Spain, just look at Portugal, just look at Greece. And they have the evidence for their position, right? But I do believe that actually both are right and wrong in some way. Because after studying this topic in really details and at different levels, policy making, theory, empirical work, I do believe that the cost, net cost or net benefits of euro is something should be seen as a potential that you can tap on, that you can have or not have, depending what kind of policies you conduct. Let me give you an example. For example, in all the reports, including the Polish one, there is a strong effect of positive effect on growth and GDP coming through lower interest rates translating to high investments. It's obvious when you lower the interest rates, the cost of investment credit is going down, so companies are expected to invest more.
And let me just go back a step. The lower interest rate should come about by a lower risk premium when a country joins the.
Yes. So you fix the exchange rate, so the exchange rate is not fluctuating, the risk is going down. So because the risk is going down, the interest rate is going down. And then a lot of benefits in all these reports are driven by the investment expansion through it, right? But there's an assumption here. The assumption is that when you lower the interest rate, investment will go up. But actually something else could happen. What could happen is that consumption would go up, right? Not investments. And what also could happen, and we could see in many countries, even if you assume that investments will go up, then there could be good investments or productive investments, not productive investments. And you could see in Spain how many unproductive investments there were. So then, if you see this, then you can ask yourself a question. Okay, if you want to tap on this benefit from lowering the interest rates, what you have to make sure is that this low interest rates translate not into consumption but into investments. And second, when they go to the investments, that they finance productive investments and not unproductive investments, like for example real estate, on this kind of things, right? And then you can set up policies for it.
So what kind of policies are these that you have in mind?
So, first of all, it depends on the country. So I cannot give any general policy advice to any country. It depends on your country, on the structures, on how it is in a specific case. But for example, a good macroprudential regulation and good macroprudential supervision of the financial sector in general and the banking sector specifically could be something that could be used to lower the risk of a consumption boom that could be unsustainable. It's very difficult to do because Spain was, when there was a boom in Spain, they were trying to introduce certain measures and regulatory measures to dampen it somehow, and they were not very extremely successful. Although they were much, some of them worked really well, right? But after the crisis, you can reconsider some of the things and ask yourself, well, maybe we should be more conservative on some things in terms of consumption, right? So this could be one thing, and second also. When we talk about the investments, right? A very important element for making sure that when you lower the interest rate, investment go up, is to make sure that you have as little as constraints on investment activity as possible. All this red tape, the bureaucratic burden that you might have, and certainly we have in Poland,
corruption,
all this regulatory, business regulation that is unfriendly to business, that is an obstacle for investments to go up. So if you remove that and you remove these constraints, it will be easier for this low interest rate to translate to investment activity, for example.
When you mentioned, your report, and there have been other reports, they would generally find the benefits to outweigh the costs. These reports were primarily written before the crisis, but quantitatively, what kind of, how much was there of a benefit was there in terms of increase in GDP and so on?
Yes. So it depends on the country, but in Poland, the estimates that we had was that the GDP over the longer period of time would be about 7 to 12% higher with the euro than in a scenario without the euro. Okay, but as I said, this 7 or 12% should be seen as a potential. It is not that it's given. It is not that when you adopt the euro, it will be there. It depends whether you will make sure that the effects of euro that you would expect, that it would really materialize, as we discussed, for example, with the investments activity, right? And in all other countries, the effects were quite similar, maybe not in the range of 12, like in the case of Poland, but certainly in 6, 5, or 8, depending on the country.
Right, so and now let's go back to the potential disadvantages of a monetary union. One of the things that is often discussed is the moral hazard, is the kind of free riding of some of the countries, especially the smaller members. What is this about? Sometimes people talk about a bailout and these kind of things.
Yeah. So there are different ways of thinking about it. For me, one of the best ways of thinking about it is to see that when you the arrangement that we have right now in the euro area, the EMU, the arrangement is this: look, if you adopt the euro, it is irrevocable. So it is lifetime contract. You will never leave, right? And in fact, we don't have any solution for an exit. There is no treaty provisions. There's no treaty provision for how to exit the euro area. Okay, so this is a lifetime contract, but if you look closer, what it means an implicit guarantee that whatever happens, if you have any problems, we're gonna help you out.
Right? It's like the kid that knows that he or she is always gonna get the lolly, no matter how they behave. Right? There's never any punishment. There's never any.
Yes, and the kid, or for example, the kid the kid has a pocket money, and and he knows that when he or she spends it, parents will bail him out or her out. Okay, and this is the case in Greece, for example, or some other countries. Greece knows and knew from the very beginning in some ways, okay, that if they have the problem, it will not be solely the problem of Greece. The Greece knows that it will be also a European problem. And given that it's partly also a European problem, Greece can go and say, look, you have to help us, because if not, you're going to suffer too. Okay? And therefore I think, I think that it would be reasonable for Europe and for the euro area to introduce exit rules. So a treaty provision that would say, you know, look, any country can leave the the euro area, and there are, the procedure would like this, and if a country decides to leave, these are the costs, of doing this, and this is the cost sharing scheme to do it. And then I think it would change the perspective, because then Greece would say and go to the European Union or the euro area would say, look, we have a problem, so you have to help us out. And then the rest of the euro area would say, look, you can always leave if you want to, right? And then the position of Greece would be
So
less...
it's like the kid that asks for more money, like you send them to go and work at McDonald's to earn some more money.
Yes, yes, and I think it would shift the dynamics of the negotiations, shift the dynamics of, and reduce the moral hazard. In fact, I not only think so, but with a colleague of mine, we wrote a paper, a theoretical paper that shows that this is really the case. But I understand it's very difficult politically to introduce such a mechanism, especially today. Because imagine, today, during the crisis, when financial markets are so uneasy and people are kind of afraid of what's going to happen, imagine that we have even internal talk between the governments of an exit, and it leaks to the press. Of course, it will have a huge impact on interest rates, on spreads, and eventually on fiscal balances. So I understand this is difficult today.
Let's just think about, you mentioned the crisis, and let's just think about the current environment and the behavior of monetary and fiscal policy. Monetary policy has done some extraordinary thing. We call it unconventional policies. And basically, when monetary policy runs out the usual instrument, meaning reducing interest rates all the way to zero, then it does other things, like this thing called quantitative easing. So what's the point of this? And is it right that the critics who are afraid about higher inflation, potentially higher inflation in the future, do they have a point?
I do believe they have the point. And I think this is a big threat for these unconventional policies. But if you ask me, if you were a governor of the European Central Bank or the National Bank of Poland or the Federal Reserve, would you do that? I would say yes. And the reason is this. During the Great Depression, what happened was that the central banks, in particular in the United States, did not provide liquidity at all. Okay, what were the results at that time? Look, the GDP in the United States fell by about 20 or 25%. The production activity fell by 20, 25% or even 30%. Unemployment rate went from around 4% to 15%, in some sectors to 25%. Now let's compare this data, the fall in GDP of 20, 25%, unemployment from 4 to 15 and 25 in some sectors, to today's data. Today's data are much less negligible. If you look at the United States, the GDP actually over the last couple of years when the crisis started did not fall. It's more or less in the same level, even high maybe today, right? So I think this policy that were implemented during this crisis were in this case sufficient if you compare it with the case of Great Depression, right? Now, other risks of these policies, yes. Do we know how big these risks are? Theoretically, yes. We don't know whether they materialize, but we will see. But there will be a learning for us. We are in the uncharted territories somehow, but I think it was wise to use something else because the policy of not doing this in the 30s actually was a disastrous.
I agree with you that the United States, comparing this Great Recession to the Great Depression in the 1930s, the current situation looks much more favorable. And in fact, I guess one of the reasons for the different behavior of the central bank was the fact that the chairman, Ben Bernanke, was a scholar of the Great Depression, and he studied Friedman, and he knew that one of the big mistakes in the Great Depression was not letting the money supply shrink. But if you look at the European data, the situation doesn't look as good at all. In fact, Paul Friedman had a couple of weeks ago, he had a blog post where he's comparing the GDP in the Great Depression with the GDP in the current recession, and he shows that in Europe we're basically now at the same point if we start from the pre-crisis peak. So it seems like certainly things could be better in Europe, and now we're moving on to the current austerity policies. You're mentioning that there was a need for big monetary stimulus. And the implication is that maybe we should also have a fiscal stimulus, but in fact we're having the exact opposite. We're having austerity measures, we have higher taxes, we have budget cuts. How do you reconcile the need for stimulus with these austerity measures? Are they a bad idea?
Yeah, so the situation in Europe is different. Partly it's different also because the European Central Bank was much more reluctant than the Federal Reserve to actually provide the stimulus, because even if you think about the long-term operations that the European Central Bank announced a year ago, they were not implemented. They were conditional. It's only a possibility. So the central bank was much conservative, and if you look at the data, in particular the money growth rate, you would see that in Europe is much. It's growing much at a lower rate, and in some countries like Greece, like Spain, like Portugal, there is a construction of monetary aggregates, and partly this explains also the recession they are going through. But in Europe we have also something else, namely we're moving from one place which is kind of a monetary union with loose fiscal consolidation to possibly to a monetary union with a fiscal union, and which would involve also some political union. So we are in a transition, right? So even though the equilibrium, the long-term equilibrium, could be, that the possibility for using the fiscal policy and fiscal transfers freely, as it is the case in the United States, to stabilize, today maybe this is not wise to do. Imagine, for example, that we are partners in a business, right? And you lose money, a lot of money, right? And you go bankrupt, almost. And I am to provide you financing so that you can repay your debt. This is the case of Greece. Greece went bankrupt. There is a lot of bonds and a lot of money that Greece owns and it needs to repay to the financial sector, but Greece does not have it. Okay? So then you come to me and say, look, help me out. And I would say, okay, so what would you do? Would you give the money straight away? No, you would say, no, look, I will give you the money, yes, but you have to make sure and you can guarantee that you will do something with your business so that you will be able to repay this money back. And that's the situation today. I understand Germans. And this German position, look, we are willing to give you money because we are willing to invest in the European project. But if you do so, we want to make sure that you do your homework, that you change your economy, that you undertake the necessary reform process, so that in the long run you will be able to pay us back.
But I agree, but I think the word "in the long run" is the key here, because there's a big difference. The debate is always, should Europe spend in order to stimulate the economy and get over the current weakness, or should Europe save in order to deal with the long-term fiscal unsustainability problem? And I think it's actually both, and it's neither, because what we need is a long-term saving in terms of dealing with aging population. So we need long-term reforms of the pension system, healthcare systems, and so on, to make a policy sustainable. And once you do that, it will actually allow you to provide a short-term stimulus. So you kind of save in the long term and you spend in the short term. But Europe seems to be doing the very opposite. I mean, it's not doing the structural, long-term reforms of the pension system and so on, and healthcare systems, but it's doing the short-term, arbitrary short-term austerity measures, cuts. And these are counterproductive because they actually drag the economy and slow down growth and increase debt to GDP, and they're basically a vicious circle. I think this is a problem. I agree that the Germans should have demands, or you know, all countries should have demands on the other countries, but they should not be, you know, reduce your deficit now, but it should be, you know, do the long-term reforms. And so I think, you know, it's not the implementation is wrong. Would you agree?
Yeah. So look at the United States, okay, and the monetary or fiscal union in the United States. What happens in the United States is this: if any state has a problem, okay, like a recession, okay, there's a flow of funds from the federal government to that state, right? So, and this flow is unconditional. If you have big problems, you know, you will get more money. Mm-hmm. For example, when the United States announced the federal stimulus of the 700 or 800 billion dollars, a huge one, right? You know, California got, I don't know, I can't remember exactly, 35 billion, okay? Even though their fiscal balances were really in a bad shape and there was, you know, terrible situation, right? So what happens in the United States is that the money is transferred from the center and it's unconditional. Nobody gives any conditions for California. You know, you have big problems, you get it. So if we want Europe to work in the long run, and we believe that this the system in the United States that we have is a blueprint to some extent. We should create that. But should we do it today? Meaning, should we transfer this money right away to Greece? Even though, right? So I think there are different policies that are needed in the transition period to get to the right equilibrium. And I think Europe has to manage both, and therefore sometimes it's kind of blurry, it's sometimes fuzzy, we don't know whether this is right. But I think on average, I think the policies that have been implemented so far in Europe, even though they are difficult, frustrating, and we get angry somehow looking at the summits, I think this is one of the, maybe the optimal path to go. Very dangerous, but an optimal one.
When you're talking about the danger that some people, and we're back to unconventional monetary policies and so on, the danger some people point out is a new bubble developing, and it's probably most apparent in the United States, where we have a very counterintuitive situation. If you plot the stock market indices, S&P 500 for example, there's an almost perfect correlation with the federal balance, the balance sheet of the Federal Reserve, which means that the markets basically, whenever there's bad news, under normal circumstances, stock markets should go down. Currently, it's the other way around. If there's bad news, stock market goes up, and this is because it means that they anticipate that the Federal Reserve is going to keep pumping money into the economy, into the financial system. Yes. When you look at that, and most economic theories say that the stock price should reflect the economic fundamentals. Is this one of the threats that you mentioned, that we may have another bubble, as we did in the early 2000s? When the Federal Reserve let interest rates kind of too low for too long, and it contributed to the housing bubble and so on. Is it something we should worry about, and is there anything that the policymakers can do to maybe deal with that bubble?
So I think this is something we should worry. I think this is something. I think that the bubble will burst for sure. Okay, the question how. And what we can do what we can do about it, okay? And I think this is the biggest challenge now that we have for monetary policy and central banks around the world. And the question is when we should start raising interest rates and going out of this conventional monetary policy. Where is the end of it, okay? And then once we decide to start doing this, the question is how fast do we do this, okay? And I think there's a great risk that we'll be doing this too late. We'll start doing this too late, so the bubble will go bigger and everything will collapse. And therefore I believe that today's kind of kind of good news that we hear from financial markets and and economic growth around is temporary. It's gonna finish in some time. So I think there's a lot of difficult times ahead of us.
This is kind of a little bit contrasting your initial optimism about the future of the euro, but I'm really hoping that your initial remarks were right, and then there is a way for a kind of successful euro and prosperous Europe, although it may not seem like that at this stage. But I would agree with you that if the interested parties work together, they may make some institutional improvements that would make the situation better.
Yeah, but this position, this kind of a pessimistic view about the current developments in the real economy that I said at the beginning, they are consistent with the beginning, not necessarily inconsistent with the beginning what I said, because I do believe the situation will be difficult, and the crisis is not over. It's gonna be with us for certain period, still a couple of years with us. But despite these difficulties, Europe and the Euro area will survive, will not break up. No country is going to leave the Euro. But as I said also at the beginning,
so now you're back to the crystal ball.
We don't know eventually what will happen. But for the time being, this is what is to me and according to me the most likely scenario.
Well, I'm afraid we're out of time, but I'd like to thank you very much for your interesting insights and for your ongoing contribution to public policy making and all the contribution you're making to the society, the Polish society, as well as your role in Europe. So thank you for joining us, and best of luck for the future. Thank you.
Thank you very much. It was a pleasure.
Professor Cezary Wojcik.
Thank you.
Thank you.
Thank you.